Hello, folks. We're going to start in about a minute. It's about 11:59. Welcome. And we are just checking my clock here. And we will be kicking off pretty soon. I'm going to let my clock go to about 12. Okay, I think we should. See where numbers are going up. We've got about 26, 27. I'm going to let some folks get into the room. I understand we have a lot of registrants. So when I see that my participant number go up to closer to about 100 or so, the next minute or two, we will kick off. In the meantime, as folks are settling in for this session, if they don't mind kind of putting what part of the country they're from in the chat, we are trying to make sure that we're capturing a wide reach of folks and would love to know where folks are from who are participating in this first part of a 5-part series. Yeah, I see a couple of people have their hands raised. If it's possible, if you can put your question in the Q&A. And then, Andrea, I see that had someone who's noticed that that our chat may be disabled. Yeah, I just am getting a note on my text. Got it.
Yes, please try again. It's been enabled.
Okay. Okay. All right. I did say we would wait until I saw 100, but I think because it is now 12:03, I'm going to kick this off. Welcome, welcome, folks. Welcome to the first of the 5-part series for Equitable Path Forward. Equitable Path Forward is Enterprise's program for really advancing and building the capacity of our BIPOC partners in the marketplace. We are very excited to kick this off. This is the first of a 5-part series, Cdfi Basics, Preparing a Lender Path.
Monica, you were accidentally muted. Please unmute.
Oh, sorry, I was muted. Welcome again. This is the first of a 5-part series, Equitable Path Forward. It is Enterprise's effort to help build capacity for our BIPOC partners in the marketplace. The first is the Cdfi Basics, Preparing a Lender Package, which will be offered by 2 experts from Enterprise Community Loan Fund, Josh Griff and Sharon Bowlers. Ms. Bowlers has been part of the ECLF team since 2016. Her role involves working with partners to build a pipeline of projects in such asset classes as affordable housing and community development. Mr. Griff joined ECLF in 2015. He's transitioned over to the Director of Credit this year. And in his current role, he works with both our lenders and asset managers in reviewing and structuring new loan opportunities and managing outstanding loans. Mr. Grip is based in Denver, Colorado. Ms. Bowlers is based here in our Mid-Atlantic region, and actually I am as well. I'm part of the DC Mid-Atlantic office. I lead our business development efforts, and I'm really, really pleased and proud to kick off this program for you guys. There will be opportunities to do a Q&A after a certain section, and I'm going to let the slides guide that. If you have questions during the presentation, please put them in the chat. We'll be monitoring those questions and we'll be taking them as needed and as we see them come up. This is designed to be a presentation for you, and our interest is to make sure that we can provide as much concise and helpful knowledge in this 2-hour time frame. So with that, without further ado, I'm going to kick it off to, I believe Josh is starting it, or Sharon is starting it. I'll turn it over to Sharon, and we will go from there. Sharon, welcome. Thank you.
Yes, thank you, Monica. So next slide, please. Can we get the agenda? Thank you. I would like to take this opportunity to welcome you to our session today on Cdfi Basics. As Monica mentioned, this is the first in a series of offerings by Enterprise. And during our presentation today, we will start by giving you an overview of Enterprise and Enterprise Community Loan Fund, or ECLF. And this will include information on the types of products that we offer. We will then walk through the process of applying for or initiating a request for a loan. We'll also walk through the process of providing the necessary due diligence, as well as what we look for or consider as lenders when we're evaluating a request and underwriting a loan. Then we will take a deep dive into what is required to prepare a lender package. So once we start talking about the process of preparing a lender package, we anticipate that we will be throwing a lot of information out at you. So as we move through this part of the presentation, we encourage you to type your questions in the Q&A, and we will try to pause after each slide to address your questions as they come in. So next slide, please. Our vision and mission. As a national nonprofit, our mission is to make home and community places of pride, power, and belonging, and platforms for resilience and upward mobility for all. Next slide. So how do we do this? So Enterprise's approach. Enterprise is one of the leading national nonprofits focused on addressing the nation's affordable housing crisis from all sides. To achieve these goals, we operate across 3 divisions: our solution, capital, and communities. Our solutions division engages in programmatic, policy, and advisory and capacity building at the national, state, and local level, working in communities and in collaborations with thousands of partners in the nonprofit, public, and not-for-profit sectors. Our capital division comprises several subsidiaries where we invest and asset manage a range of tax credits and equity, along with our community development finance institution and a controlling interest in Bellwether Enterprise, through which we provide access to conventional mortgage products. Our communities division is the nation's 5th largest affordable housing nonprofit developer, owner, operator, and provider of resident services. With over 40 years of experience and thousands of local partners, Enterprise has built and preserved close to 800,000 homes and invested over $60 billion in communities. Now I will turn it over to Josh.
Okay, next slide, please. Okay, so what is a CDFI? So a community development financial institution. So CDFIs are mission-driven private financial institutions dedicated to delivering financial products to traditionally disadvantaged people and communities. CDFIs finance a range of community-serving activities, including small business, micro enterprise, nonprofit organizations, commercial real estate projects, and affordable housing. So CDFIs are capitalized, or the money that we're lending comes from investments from corporations like banks or healthcare companies. It comes from government, individuals, religious institutions, and foundations. A crucial source of capital for many CDFIs is through the Cdfi Fund, which is a federal agency in the Treasury Department. So the Cdfi Fund has a certification process for lending institutions that provide financial services in low-income communities. So the Cdfi Fund certifies CDFIs, and once a CDFI is certified, it becomes eligible to apply for awards through a variety of programs offered by the Cdfi Fund. And so these awards, combined with those other investments that I spoke of from banks or foundations, individuals, enable CDFIs to finance our targeted lending activity. There are now around 1,000 CDFIs certified in the United States by the Cdfi Fund. Next slide. So Enterprise Community Loan Fund is the CDFI that's affiliated with Enterprise Community Partners. We're a national CDFI. We offer financing to support the acquisition, development, and preservation of multifamily affordable housing around the country. We also provide financing for community facilities with a focus on financing federally qualified health centers, charter schools, and grocery stores that will offer fresh food options in food deserts. We've also provided some financing for solar development projects around the country when the solar is benefiting affordable housing properties and/or its residents. Next slide. And so here's some general information about Enterprise Community Loan Fund and our impact. We currently have total assets under management of around 400 million and about $230 million in loans outstanding. We've closed over 2,200 loans since 1983 when Enterprise Community Loan Fund was founded, with over $2 billion in loans closed to date. Our 10-year average loan losses are less than 1%, which gives an indication of our track record in making good loans that repay and that achieve our desired result of construction and preservation of affordable housing and community facilities around the country. Next slide. And here's a look at the types of loans that we're making at Enterprise Community Loan Fund. So ECLF is primarily a short-term, early-stage lender for affordable multifamily rental housing projects, with a bulk of our activity being acquisition, pre-development, and equity bridge loans and low-income housing tax credit and historic tax credit projects. We also provide some mini permanent financing and permanent financing, as well as new market tax credit leverage loans. As Sharon will discuss more in a minute, ECLF is now offering working capital lines of credit to eligible BIPOC-led affordable housing developers to support their capacity to develop affordable housing projects. We are typically collateralized in a first lien position on real estate. We can do some unsecured pre-development, equity bridge, and these working capital lines of credit. We make loans to nonprofits, mission-aligned for-profits, and municipal agencies like housing authorities, and our borrowers have a track record of success in developing affordable housing. While we focus much of our lending activity in enterprise core urban markets, we also can make any of these loan types in rural and suburban areas for projects that are a good fit for our lending programs. Next slide.
So thank you, Josh. So now I'm going to talk, just give a little bit of background about our equitable path forward. So the equitable path forward is aimed at supporting Black, Indigenous, people of color, also known as BIPOC, and other historically marginalized housing providers. Next slide, please. So the EPF is a new 5-year, $3.5 billion nationwide initiative to help dismantle the deeply rooted legacy of racism. This initiative will take on a multi-pronged approach and will include, first, filling in the capital gap, second, strengthening providers through advisory services, and third, creating new career pathways to diversify leadership in real estate. So next slide, and now I will pass it on to Josh to start our discussion on preparing a lender package.
All right, thanks. And let's advance one more slide. So now we're going to get into the meat of today's presentation, preparing a lender package and what to expect to get through the loan underwriting and approval process. So we're gonna go into depth into the loan application and the application process, the term sheet, and our due diligence checklist to provide an overview of what a CDFI lender like Enterprise will need in order to get to a loan approval. And obviously this presentation is geared toward the loan process related to an affordable multifamily rental housing project, CDFIs that focus on business lending or for sale housing, mortgage lending, down payment assistance will be looking at very different information in their loan review process. So we're coming at this presentation today from what we know best. We provide financing to support affordable multifamily rental housing development. Next slide. Okay, so the first step in the process is to contact your lender to discuss the project, to see if the project is a good fit for the CDFI and to get a sense of the application process and what the lender is going to need in order to move this to the term sheet stage. So if in discussing the project with your lender, it sounds like a good fit, the lender will ask you to submit an application and provide you with the application form. I would suggest building as complete a story as possible for your lender at the time of that initial discussion. So to the extent you can, be prepared to identify a lender whose activity fits clearly with the project you're proposing, present a clear loan request with an identified need for the loan, the repayment strategies, collateral options, and how you propose to guarantee the loan. So the clearer the fit with our lending activities and our products and guidelines, the easier it will be to get buy-in and for the lender to request for you to submit that application. So if it's a good fit, we'll send you the application to complete. ECLF uses a short 1 to 2 page application form that will provide us with kind of general information on the loan need and loan amount, who is the proposed borrower, the sponsor of the loan and guarantor for the loan, how do you plan to use the loan proceeds, what's the proposed project you're pursuing with the loan dollars, providing the anticipated number of housing units, total development costs, and square footage that you're anticipating building. And you will also be asked to define how you plan to repay the loan, what your proposed collateral for the loan is in the initial anticipated project timeline. So if you're a new borrower to the lender may also ask you to provide a recent balance sheet and operating statement to understand the guarantor financial capacity for the loan. This information will be important for the lender to be able to draft a term sheet and for us to structure a loan that fits your financing need and determine the best product and program from which we're going to be making the loan. Next slide. Okay, so you've submitted the application, the lender likes your project, and they think they can get the loan through their approval process subject to full underwriting. And so now they're preparing to issue a term sheet. So the term sheet is a non-binding document that outlines the general structure under which the lender is willing to make a loan. So this is the deal that the lender will underwrite and will seek approval for. And so I'm going to talk through what you're going to find in that term sheet. So the term sheet will define who the intended borrower is for the loan. Depending on the loan type, this might be a single asset entity to acquire a property, or in the case of a working capital line of credit or a pre-development loan, the borrower may be your organization or company. The term sheet will also detail the loan guarantee requirements. So CDFI loans are typically full recourse obligations to the borrower, and ECLF will typically require a full loan guarantee. For-profit borrowers and guarantors, ECLF will also typically require that the principals of the company provide personal guarantees for the loan. We're also in the term sheet going to provide the loan purpose, the anticipated loan amount and loan term, and the pricing for the proposed interest rate and origination fees for the loan. As I mentioned in the application, you're going to be providing us an anticipated project timeline. And so the term of the loan will be determined in part from the project timeline, that was presented to us, and we're trying to offer a realistic loan term that meets your need to get to loan repayment, but we also want to have generally the shortest term possible to get to loan repayment as soon as reasonably possible. We're also going to define in the term sheet the collateral and loan to value requirements, which may dictate the loan amount in the case of an acquisition loan, for example. So if we're making an acquisition loan, we need to order an appraisal, and we may not be able to determine the final loan amount until we have the appraised value for the property. Enterprise uses the lesser of the appraised value or purchase price in determining our loan amount. So if our loan to value requirement is, say, 75%, the loan amount would be 75% of the lesser of the purchase price or appraised value. And I'm going to talk more about the appraisal in a little bit, a bit later in this presentation. So in the term sheet, we'll also detail the loan repayment terms. We're going to detail whether or not an interest reserve will be required. If it's a pre-development or an acquisition loan, our repayment will typically be the closing of construction financing for the project. If it's an equity bridge loan, the repayment will come from the tax credit equity pay-ins during the construction process. But the anticipated repayment plan, it will be outlined in the term sheet. And so there is agreement between the lender and the proposed borrower on how we will proceed with underwriting the anticipated repayment of the loan. We're also going to detail how we anticipate dispersing the loan. So if it's an acquisition loan, of course, we'll be dispersing the loan in full at closing, but may be holding back an interest reserve to cover interest expense during the acquisition loan term. If it's a pre-development loan or a working capital line of credit or an equity bridge loan, we're going to detail what will be required for disbursement for those purposes. This may include backup documentation and invoices, a pay request from a general contractor and inspection reports. It really just depends on the type of loan and the project where we're looking at. And so we're also going to include any anticipated covenants related to the guarantee or the project. So you may be required to maintain a certain amount of liquidity or net assets during the term of the loan. For example, this type of covenant may be included in your term sheet, or the term sheet may say that financial covenants may be included subject to underwriting in our review of the financial information provided to us. This gives us the ability to review your financial information in detail and determine if financial covenants are necessary. Or if we're using a specific lending program, like our Capital Magnet Fund program, for example, we will have project-related affordability covenants that will be recorded on the property at the time of our loan closing to ensure long-term affordability for the site. These affordability covenants and those requirements will be outlined in your term sheet. Again, we want to be sure that both the lender and the borrower are clear on all of the key deal points and what we're planning for in seeking approval for the loan. And then lastly, the term sheet is going to provide the anticipated reporting requirements for the loan. So this will consist of quarterly and annual financial reporting requirements from the borrower and or the guarantor, updates on the project and the status of anticipated repayment, and any affordability related reporting that may be needed depending on the source of funds we're using to fund your loan. So once the lender has received approval from credit to release the term sheet, they're going to send it to you for review. You as the borrower will sign the term sheet if you feel like the proposed loan fits with your financing needs. The lender will require a signed term sheet and an application fee to start working on the loan underwriting. So when you sign a term sheet issued by the lender, you're getting them going on working on this loan assignment. We typically say that once you sign the term sheet, we need about 45 to 60 days for loan approval and closing. And that really depends on our pipeline of deals and underwriting. And so we're really looking for as much time as possible to be able to dig into your project, complete the underwriting, but also stay on track with the other deals that we're working through our pipeline. So be prepared to give your lender and yourself enough time to get through the due diligence and underwriting and approval process. Next slide.
So yes, thank you, Josh. So as Josh mentioned, once you've gone through the process of the negotiation of the term sheet, you've signed and completed the application. And now it's time to move to the actual underwriting. And that requires us going through the due diligence. And as part of the process, we'll provide you with the due diligence checklist, and that will be the items that the lender will need in order to actually underwrite deal. So now I'm going to start by going through the parts and highlighting the items on our due diligence checklist. And again, these will be likely for any CDFI or lender. So next slide, please. So we can actually look at our due diligence checklist as consisting of 3 parts. The first part would be information on the project, so project information. The second would be we need information on the property, so we call that the real property documents. And then lastly, we'd look for information on the borrower or the sponsor. So now I'm going to talk about, I'll begin by talking about our project information. And so what's highlighted here are not all of the items, but just some of the key aspects of the project information that as lenders, we would need to actually underwrite the transaction. So first we would need the project narrative. We would need the project budget, and this consists of several budgets. We'd look for an acquisition or a pre-development budget. We'd have a development budget or an operating pro forma. And then if you're acquiring a property, we would need to see evidence of a purchase and sale agreement. And then lastly, we would look to see any evidence of committed funds. So next slide, please. And so starting out with the project information, a number of these were covered previously, but want to dive a little bit deeper into what this document should contain. So generally, this will give us a general overview of the project. It will identify who the borrower and who the guarantor would be. It should consist of some information concerning the actual project. So for instance, like the number of units that will be developed. And then it should also indicate what the AMI targets, whether this project will be affordable versus market rate, and also just the overall project type. It should, what's another beneficial piece of information to include is just a general overview of the market. And the reason why this can be beneficial is that potentially the lender may, the deal that you're working with may be outside the scope of the market that the lender may be familiar with. So it's always helpful to have some background information and some general market general market data on the project, on the location of the project where that you'll be developing. Again, the project timeline is another critical piece of information. So it's always important to understand not just overall what your timeline are for the individual steps that you would need in order to not just secure financing, but also get the project through to completion. And again, we'd want to have a good understanding of who the development or the sponsor team may be. So next slide, please. And so now we're going to delve a little deeper into each of the project budgets. And again, assuming this is either an acquisition or pre-development budget, we'd want to have a budget set out, and that budget should really have both the sources and usage for the funds. Again, for the development budget, if this is a construction loan, we'd like to see the construction budget. And then we'd also like to see the permanent budget affiliated with the project. And of course, if it's a rehab, we'd like to see the scope of work and the budget again associated with that project. And then we'd also want to see an operating pro forma. If this is an operating project, we'd want to see what that looks like. We'd want to see during the holding period how you anticipate the project will perform. And then, of course, we'd want to see post-construction completion, what you anticipate that the operating performance of that project. So next slide, please. So here, and I don't know if it's possible to zoom in a little or if folks can see clearly, I presented a, this is an example of an acquisition loan of an operating property. And I selected this one because I thought it was done really well. And the sponsor included listed out the sources and the usage and did a good job of breaking everything out. So as you can see, in this one, and I'll just go through kind of line by line to explain what these items are. And so as you can see in the first line item under the sources, we have the first mortgage, which would effectively be the loan for the project. The second here, you can see there's a home mortgage assumption. So since this was or is an operating property, part of the funding sources was an assumption of a home mortgage on the property. Now this can actually, you can have something similar to this if you're acquiring a vacant land and there's a seller's note or something that's already on the property that will be assumed and will be subordinate to the senior lender. And that can also be another form of this type of loan. Here you also see there is equity. The sponsor included equity in the form of a down payment and their closing costs, as well as we can see the earnest money deposits. And just want to emphasize here that, again, there was equity invested into this project as part of the funding sources. And so as your lender, we will look to see that you have some kind of equity, and again, the amount, percentage, and so forth can vary, but we do like to see that there is some type of equity invested in the project. So then we can move down here and look at the uses. So of course, the primary use is the actual cost of, or the acquisition cost of the project. But here again, the sponsor did an excellent job of just laying out all of the usage that will be invested in this budget. We see here they have their application fee, their origination fee, as well as indicated here the lender legal fee. And as a lender, we will be utilizing legal to support the closing of the transaction. And we expect, and it will be required that the borrower pay the lender legal fee. So it's important that you calculate that, or you include that as part of your total cost for the usage. We see here again, they include a capitalized escrow for taxes as well as insurance. And this is a year 15 project, so they have light tech recapture. This is not necessarily something that you see frequently. And now I want to jump down to, again, just the fees associated with closing. We see here they included their title fee, again, their legal costs, as well as the appraisal and the due diligence items that are actually necessary that as lenders that we will need in order to close the loan. Again, this is the environmental, the market study, property needs assessment, and really all of this, we want to see all this information because we want to make sure that you're budgeting accurately so that you know what you'll need to come to how much cash you'll actually need to come to closing. And one last thing I want to emphasize here is the interest reserve. It's frequently we will include interest reserves as part of our loan, and the interest reserve will actually decrease the amount of availability that you're actually able to borrow on the loan. So take, for instance, if your loan is $1 million and we have a $100,000 interest reserve, the effective amount that you're actually able to borrow is $900,000. So again, I want to make sure that you're factoring all of that in as you put your budget together. I'll pause here and see if there are any questions, since we just went through this budget. I know we said we'd pause from time to time, see if there are any questions that can come in.
Yeah, there was a lot of information that was presented over those first few slides, and we really want to make sure that if there's any kind of questions that folks are putting them in and populating so that you can have a chance to really have your specific question answered intentionally and as comprehensively as you need. So I'm going to just allow for about a minute or so for folks to just type something in. If we see a question, we will definitely stop to take it.
It looks like there's a question about the two legal costs that are included in the uses side of the budget. And it appears to me like one is the lender legal fee, and the other would be the legal cost for the borrower and your legal counsel to close the transaction on your side.
Yes, that's correct. It is important to factor in both your legal cost as a borrower as well as the lender legal cost. So that's why you see the two legal costs included in the budget there under the usage.
Thank you on that. Are there any other questions? Okay. Let's proceed. And again, please feel free to put your questions in as they come up. When we, if I need to, I'll figure out how to intervene, stop and pause so that that question can be answered. Thanks, guys.
Okay, thank you. So next slide, please. Okay, so again, here we see another example of a budget, and this is for a different project. And here we have the sources and usage for the permanent sources and usage for a project. So when evaluating your development budget, we will first start by evaluating each of the sources in your budget. Now the budget presented here has a pretty limited number of sources, and depending on where you are in the country, your capital stack can look very different. So take, for instance, deals that I underwrite in the Ohio region. These tend to have pretty large capital stacks, as developers often have to pursue numerous sources at both the state and local level in order to be able to complete the capital stack. Whereas deals in DC tend to have less sources, and that's because the district has probably one of the most generous housing production funds, trust funds that I've seen in the country, and can provide substantial subsidies to projects developed in the district. So either way, we'll want to get a sense of how likely you are to be successful at acquiring each of your sources. And since most affordable housing projects are financed using low-income housing tax credits, if your project includes LIHTC, we want to evaluate how realistic your assumptions are around the LIHTC. So we'll look at whether your project assumes a competitive 9% versus the non-competitive 4%. And in recent times, because many states have been hitting their cap on taxes and bonds, we'll look to see if the project is at 4%, how likely is it that you can access the required bonds? We'll look to evaluate your assumptions around pricing. If you do not have LOI or letter of interest from an equity provider, we'll compare your assumptions to information that we receive from our own syndications team to see how realistic your assumptions are. We'll also look at how successful you've been in the past at securing tax credits. And on the soft sources, and basically any other source within the budget, we would want to understand first, what the source is. And this is because the various states and local governments have various funding sources and requirements for achieving those. We'll want to understand where you are in the process for securing those sources. We'd want to know how successful have you been in the past at securing that particular source. and as well as how competitive is that source in terms of funding. And you'll see here in this example actually includes grants. However, we would not typically factor in grants. If your budget includes grants that are not already secured, we would want to see alternative sources so that if there is a gap, that there is another funding source that could potentially cover it. So on the usage in the budget, the first thing we're going to look at are your assumptions around construction costs. We want to understand how you determined your estimates to determine how accurate they may be. This may be, you may determine your estimates using around the average cost per square foot, or if they're based on actual estimates from an actual contractor. We'll also look at the remaining assumptions in your budget. This includes your contingency. And for contingency, we usually look for about 5% for new construction and 10% for rehab. We also look to see that the project and development assumptions meet local requirements. This includes developer fee limits, the per unit maximums, and again, these will vary based on each state's or locality's requirements. We will look at your assumptions around deferred developer fees. Our general rule is that deferred developer fee can't exceed 50% of the total developer fee. Overall, we'll compare the total development costs to see if they are in line with similar development projects of similar size and unit count in the local market. And again, if this is an operating property or even sometimes vacant land, also want to make sure you factored in your carrying costs. So while we fully understand that as early stage lenders, we may be viewing a project when it's in its infancy, and that budgets can and will most likely change, particularly if this project is new construction on vacant land, and that you're a few years out from even starting construction. But again, because we are early stage lenders, we need to be able to assess that you have an understanding of the market and that the development costs associated with the project and what it will take to close on your funding sources. We also like to see that there is some cushion in the deal. We're essentially looking to assess where can the deal afford to move around, assuming any changes. And these changes could be in the form of lower LIHTC prices or increased construction costs, which we're starting to see a fair amount now. So again, I'll pause here to see if there are any questions before moving on to the next slide.
Yeah, Sharon, there were a couple of very good questions. Someone noted that that quite a few BIPOC developers don't have the robust balance sheets. Is there a balance sheet support to help us on loans that are recourse to the borrower? I think I have an answer, but I'd rather it come directly from you or Josh. So if there's a way that you can respond to that, please do so.
Josh, you want to go ahead and take that?
Sure. I think really this is kind of the intention of this working capital line of credit that Enterprise is now offering. So if you're eligible for that program, it is offering kind of reduced underwriting standards to allow for kind of financing to support kind of operations and helping you move your deal forward. And these are, and I think, Sharon, you may know better than I here that, we've actually seen developers kind of use the line of credit really to just boost their liquidity position to kind of enhance their ability to secure construction and tax credit investment in their project.
Yes, so to kind of jump in here, and I guess we should probably differentiate. So what we're going through is the standard underwriting process, or the way we would look through a traditional deal, if for lack of a better word. But as Josh alluded, we do have under our EPF initiative, we do have, if you want to call it, an amended underwriting guidelines, for which we can utilize when we're evaluating BIPOC projects or projects by BIPOC developers. And so there is a full process, and I think we're going to follow up from this presentation with what that full process would be. But what we're showing here, what's being showcased, is really our standard underwriting, and really just if you were to apply to your typical CDFI, what that would most likely look like. So yeah, I'll pause there, see if there were any other questions.
Yeah. And I think what we're trying to offer here is also just the template, not necessarily the underwriting guidelines that we use, but really the template of basic information that's needed to make a credit decision. As Sharon noted, we do have special capital products where we have amended underwriting criteria, but I think it's very important that folks really just understand sort of the basics of putting that package together, because that's where the conversation starts in how we evaluate a particular transaction or credit request. There was a second question that came in, is that does Enterprise have an arm that helps developers coordinate the various funding sources? The rules change, the questionnaire writes that the rules change all the time, and it's kind of a full-time job to track them and manage the application processes. And for new entrants in the affordable development space, it can be really challenging to prove a track record of success in getting grants and tax credits. We do have 11 offices across the country, and because a lot of funding is locally or state-based that a lot of our partners use, what I think we are able to offer is, through our local offices, because we do have a policy arm, and we usually have folks on the ground in those local offices that are very knowledgeable about the local market. That is one sort of resource for kind of understanding when, for instance, in the District of Columbia or the state of Maryland or California is going to have their RFP. We have folks in our marketplace who can help to kind of navigate or at least provide some information on that process. But for new entrants in the marketplace, we do have Section 4 grants, which we provide on a sort of an annual basis based on a specific sort of work plan for that year. But in terms of other kinds of resources, our local market could probably help guide folks on where to go in the marketplace, at least from the public sector, and what those subsidies look like.
Okay.
Do you guys want to add anything? Just Sharon or Josh want to add anything to that?
Yeah, I mean, I would definitely say, against Monica's point, each deal will definitely be very localized. So that's why, again, it's important. And so when you have the conversation, with your lender, it's important to communicate that, because Enterprise has a very, again, to Monica's point, a large platform where we can pull in some of our other partners, be it our LIHTC or Bellwether for Permanence, or even our impact market, as Monica alluded, where we can put together, help you put together, if you want to call it, a platform and help talk through, and on both sides as lenders, and I'll just speak for Josh. We're more than willing to help you talk through that project and talk through what's necessary. So if as things do become difficult, we are here to be partners. We fully understand that everyone isn't a 20-year or 30-year multi-pronged development company. And so we're still willing to work with you. So I think that's where, again, that conversation with your lender and your partners come in, and we're more than willing to work through it with you. So I'll pause there. I think we got some other
Yeah, we've got a few more questions coming in. Are you guys available? Should we keep going with questions? Can you guys?
Yeah, yes. We thought that would probably make this most beneficial to be able to answer as many questions as possible.
So those questions come through about, will the presentation cover some of the underwriting standards, such as the required debt service coverage ratios and any other kind of sort of financial threshold ratios?
We do speak a little bit more. We don't necessarily say specifically the ratios. So to answer that question, and again, because we're again early stage lenders, and a lot of our projects tend to be there'll be interest only, and we'll often provide an interest reserve. So for our products, we won't there won't always necessarily be a specific required debt service coverage ratio determined, but what we will look for to see is for your takeout requirement, what that debt service coverage ratio is, and we'll evaluate to make sure your project actually meets that. And again, that varies, and that again will vary depending on what funding source you're using, whether it would be agency financing like HUD, FHA, or if it's going to be a conventional bank, what that looks like. So that particular requirement will definitely vary depending on which funding source you're using. So yeah, I'll pause there, see if Josh, you wanted to add anything to that.
No, I think the answer really depends. It depends on the project. It depends on what type of loan we're making. If it's a preservation loan and it's an operating property, we may have a debt coverage ratio requirement, 1.15 or better, but it really depends on the strength of the property and the strength of the guarantee, and that'll help us determine kind of where we want to set that debt coverage requirement.
And then we have another question about the $295K per unit total. Is it based on current variables and conditions, or is it merely a placeholder? I think that's really a placeholder, because depending on the market, those that per unit cost can vary very greatly. The District of Columbia, very high cost market, New York City, high cost market. I think the numbers come in anywhere between 400 and 600K. California, I heard, is up there at 600 plus K per unit. So that really is a placeholder number. Sharon, if that was the standard number, we'd be in a lot better shape from an affordable housing standpoint. But there are real world variables and factors that do inform what that per unit number. If it's a senior project, if it's a multifamily project, if it's an assisted living or supported housing project, or one that's going to have a lot of heavy services, there's a lot of security that's needed for a particular building. All those are things that really, or the cost to build in a particular market, that's all going to inform what the per unit total looks like. I took a little liberty there, but if Sharon or Josh want to add color to that response, please jump in.
Yeah, no, again, you are correct that per unit will vary drastically to your point, Monica, depending on what market you're in. But the number itself will have factored in all your total development cost, that's your hard as well as soft costs, of course, divided by the number of units. So typically, taking the markets, the same market, two projects in the same market, one where it's a larger project, one where it's a smaller project, you'll typically see the per unit cost be a little bit smaller, just because it's being divided, the denominator is a little larger. But yes, depending on where you are in the country, that per unit cost will be substantially different. And so kind of goes mentioned earlier in the discussion, which is where we will look to see, based when you've when you present your budget, what is the average per unit cost for a project in that area? And, if it's new construction, if it's rehab or so forth, and does that fare, and how does your particular budget, your particular per unit cost compare to others? So if this was, again, to Monica's point, like if you showed us something like this and you're like, you're doing this in New York, where we know per unit cost tends to be substantially higher, then that's where we probably want to get a little bit more information in terms of how are you actually arriving at that number. So, yeah, again, just to confirm, like per unit cost will vary substantially depending on what market that you're in. Again, this is just an example that was pulled just to show overall the type of information that's included.
And the other thing too, in terms of the underwriting and that per unit number, someone asked a question about sort of the subsidy market earlier. It's really understanding sort of the limits per unit in your particular subsidy market, because you want to make sure that you're marrying what that number is with your per unit number to help identify your gaps, or if there are no gaps, that's always phenomenal and great. But there are sometimes, because the public sector amount of money that's going into affordable does indeed have a limit on it. That limit you need to take into account on what is provided on a per unit basis to help round out what your development budget is going to need in terms of your sources and uses. So that's just something to keep in mind when you're developing your budget. If you're going to be relying on public subsidy, having some good intel about what your real per unit cost is and what the public sector is going to provide in terms of the subsidy. And that's both on the, what to expect from a tax credit standpoint if you're going to use credits, or any other sort of what we call soft lending or secondary source lending that's going to go into the project from the public sector.
Yes, I absolutely agree with Monica. And to flesh that out a little bit, all of that information will be pulled from your local QAP. So we're, as part of our underwriting, we'll actually be pulling that QAP, going through it, because we, as well, in order to be able to evaluate whether or not those per unit limits and so forth actually are realistic and fall within what's allowable, we'll be evaluating that. We'll be reviewing those documents and comparing them to your budget. So all of that information is available in your state's QAP or your local QAP. I'm sorry, that's a qualified allocation plan, which is usually set out by, and not to get too deep into the LIHTC portion of it, but which is usually set out by the local state, by the state or local government.
Going into the next question I see here, which is there a set limit to the fee percentage of the architect and engineering or A&E fees for LIHTC projects? And usually the state or allocating agency will have some limits on that, which would be set as a guide for anyone who's applying for those credits. Are there any dollar limits with those grants? I think folks may have been, this question, I'm assuming, and you can please type in if it's different. I mentioned something about our Section 4 grants. Usually there are limits on those grants, depending on how much we get that year and sort of what our work plan looks like and how we're allocating. But there do tend to be limits when we are providing the grants to those federal resources. I think that's all I see in the chat for now. We can, sounds like we can continue unless any other questions or comments coming in.
Okay, well, next slide, please. So here, again, continuing with project information, the next budget we're going to want to review is the operating pro forma. We'll be looking for a detailed operating budget. This will be a 15-year cash flow of your projections, and usually 15-year because, again, it coincides with the LIHTC. And that cash flow projections, which will show your income, expenses, debt, and debt service coverage ratio, your debt coverage ratio. over the life of the loan. Next slide, please. Okay, hopefully you can see this, but again, it's another example of an operating performer. And you can see here, even I think year 15 probably fell off, but this is a example of an operating performer for a LIHTC project. And again, when presented with this budget, we'll be looking at your underwriting assumptions. We'll look at your vacancy when it comes to the revenues. We'll look at your vacancy assumption. We typically underwrite to a 5% vacancy rate. Again, this will vary based on market. It may be higher if the market typically carries a higher vacancy, but we usually keep the minimum at 5%. When it looks, and we'll look at your rent assumptions. Again, we'll either compare it, we'll more than likely have an appraisal or something, some other third-party report to compare to see how realistic your rental assumptions are, whether they're above, in line, or below. Again, as affordable housing financers, we typically expect to see that as an affordable housing project, the rents would be somewhat below what the market rents are. But again, we'd evaluate your rent assumptions to see how likely those are. And then when it comes to the operating costs, we look at the per unit operating costs, and we expect again that these would be in line with similar projects in the local market or in the range of the local market. Again, really want to emphasize that so much of this will be localized, again, because obviously a project in, as Monica mentioned, a project in New York, it's going to look very different from a project in New Orleans or even Cleveland or so. The cost and so forth are going to be very different. So we're going to compare to that local market. And so overall, while efficiency is great, and this is, I'm referring to for purchase operating properties, having a project where the per unit operating costs are substantially below the market range can be a red flag for us. Because it may indicate that the developer is not investing sufficiently into the project in order to meet the needs of the residents, or not investing sufficiently in order to maintain the project in good condition. So again, we're going to look at your overall per unit cost and to see what it typically looks like to manage and operate a project in that area of that size in that locality. So the management fee, that's usually typically we see it at about 4%. We look for projects to have a replacement reserve. Again, that goes back to that point of making sure that you're maintaining the project. And so typically we see replacement reserves at $250 for new construction, and usually between $300 to $350 for preservation or existing properties. And lastly, we look at the debt service coverage. As someone asked about what that would look like, because we'd want to see that it meets the requirements for the perm lender. So typically, if your perm lender is going to be, let's say you're taking out your standard construction loan or your typical bank, that's usually about 1.25% debt service coverage ratio. So you'd want to see your project to be able to meet that, and be able to meet that on year one. If it's agency financing, sometimes those will come in at 1.15 or 1.2, and again that would vary based on that perm lender and that market. So we would look at your assumptions for, again, the rate and the term, whether these are what we see in the market, and we'd also and usually we'll perform some type of sensitivity analysis. We'd look at how vacancy and operating expenses, changes in vacancy and operating expenses would impact the project's ability to service debt. Our sensitivity analysis would also include looking at how the project would, and giving, that we're in a rising rate environment, we'd look at how the project would hold up if interest rates were to rise. So we conduct some sensitivity analysis around that. And so basically, like the development budget, we'll want to see that there is some room in the operating performer that your assumptions that it can absorb some changes in the market, because of course we're looking at this, and you're presenting this budget, and it's going to be years out, more than likely a year to 2 years before the project actually goes into operations. So we need to see that there's some room in the budget to absorb some of the shocks that may come in the market. And so I'll pause here to see if there are any questions before we go to the next slide, which I believe means that we'd be taking a 5-minute break at the next slide.
So we say 10, but I think we really should be doing a 5-minute break. So if folks can do a quick stretch, I'm going to set, I think there's a timer that we'll set, and do a quick stretch for 5 minutes, come back, and we'll re-engage with the presentation. Thanks so much. Okay, I think we're at 5 according to my, yep. So we still have our attendees. Let's continue. Thank you guys for coming back.
Okay, next slide.
Yes, so thank you. We'll continue on with talking more about the project information. And so we're going to start with zoning. This will be important if you're looking to acquire vacant land or if you're looking to develop a project and add with additional units. So we'll want to understand if the project will require rezoning, and this can be really important. We've all heard of the term NIMBY or not in my backyard. So it's important to understand how the community and local officials are going to react to your project, particularly if zoning is involved. So again, just want to understand what approvals you'll have to go through in order to need that. And again, because so many, depending on where you are, type of project that you're doing, there may be numerous funding sources. So you'll also want to understand which funding source could either, maybe delayed or something, which could potentially ultimately determine your closing time frame. So next slide, please. And so this is just, again, we'll just ask for just information. We'll, want to know who these folks are: borrower, guarantor, sponsor, GC, architect, property management, and if you're using a development consultant, who these folks are. And again, and so the GC or the general contractor and property manager may not be identified depending on where you are in the project or where you are in the process. So understand that not all of these individuals on the project team may be identified when you're speaking with us. Next slide, please. And again, just for the folks on your team, we'd want to get an understanding of their experience. And, this would come, you can, basically provide sponsor team resumes, which would basically just talk about their particular experience in the project. It's helpful to see if you're developing a project, if you've had experience developing a similar project of a similar size or in a similar market. Again, just want to know your experience with developing the project. And again, we alluded to this earlier, experience in securing your key financing options, experience with the LIHTC, or if you're pursuing new market tax credits or historic tax credits, what your experience has been with these particular funding sources. So now I will transition, I will turn it over to Josh.
Okay, next slide, please. Okay, so now we're going to get into the real property documents that we will need. And this is primarily for projects that are real estate secured transactions. So starting with the appraisal, the appraisal is going to be ordered by your lender. The lender will work with the appraiser to define the scope of the appraisal assignment and the anticipated cost and turnaround time for delivery of the appraisal to the lender. Before we formally engage the appraisal assignment, the lender will confirm with you, the borrower, that you are good with the cost and the delivery time frame before we order the appraisal report. And so while the lender is ordering the appraisal, the borrower is ultimately responsible for paying for the appraisal report. And so the appraisal will provide an as-is value of the property, and then if needed, will also be looking for an as complete or maybe a hypothetical value based on affordability restrictions that will be placed on the property. So for acquisition loans, we again typically set the loan amount subject to the loan to value requirement, and our loan amount will be based on the lesser of the determined appraised value or purchase price of the property, considering that loan to value requirement. So we'll also be looking at preliminary title reports and a survey. You're going to need to order a preliminary title report from your title company and a survey from a land surveyor. These items will be reviewed by our legal team prior to closing. We can provide you with our title and survey requirements prior to contacting your title company for new construction projects or land acquisition that will result in new construction. We typically require an ALTA title policy and an ALTA survey, and the survey will need to be certified to your lender. The survey should be produced not more than 90 days prior to the loan closing date. For preservation projects, the title company will determine what type of survey they will need to issue the title policy. It may be that the title company doesn't need an ALTA survey for a preservation project, but the survey will need to comply with the title company's requirements for use of that survey and to issue a clean title policy. Okay, phase one environmental site assessments. You're going to need to order a phase one dated within 90 days of closing. We'll need this to be from an engineering firm and that is reputable and experienced in this, and they will need to provide us reliance on the report. If the phase one assessment determines there are recognized environmental conditions on the site, then a phase two environmental site assessment will be required. And this is going to involve more depth, soil testing or investigation to determine the environmental condition at the site, any contamination, groundwater issues. If it's determined that there are environmental issues, this may become a significant underwriting issue. It does not mean the deal can't move forward, but we do need to understand how the environmental issues will be addressed, and we need to see that the development budget for the project includes the anticipated cost of remediation of the site. If needed, the lender may ask the environmental consultant who drafted that environmental report to estimate the cost of remediation, and we would want to see that included in the development budget to be sure the project is viable with these costs included. For operating properties, like for preservation, we will want to see that the environmental report includes investigation of any mold, asbestos, or lead-based paint. Radon will sometimes be tested depending on the location of the project. If these conditions are found at the property, an operating and maintenance plan will be required for closing to show how these conditions will be adequately addressed. We also may ask for you to provide a geotechnical report or a soils report. This is most often required for acquisition of property that will be developed as new construction or projects that are in areas of the country with a lot of seismic activity, or maybe it's in an area with loose soils. The soils report is going to provide a detailed understanding of the soil composition and the subsurface conditions and the suitability of the site for the proposed new construction project. It's also going to detail the type of foundation that will support the new building, how far down the piles need to go. It's a very technical document, but it helps us to confirm that the site is suitable for the proposed development and that the development budget includes the anticipated cost for site work and the foundations that will be necessary to support the development. Next slide, please. Okay, so the remaining items here are related to acquisition of an existing occupied multifamily property or maybe a commercial space. So we're going to want to see any tenant leases that will be active during our acquisition term. We're going to want to understand the term of any lease on the property, the income anticipated from these leases, tenant insurance requirements. Will the tenant occupy the site for the full term of our loan? This may impact the need for an interest reserve or how to size the interest reserve if there is operating income from the property during the loan term. In the case of a commercial property, we would want to see that the tenant sign certain agreements to ensure that our loan is not impacted by the tenant during their lease period. We're also going to ask for 3 years of rent rolls, so we understand the occupancy and kind of vacancy history at the property. We're going to want to see 3 years of property operating statements so we can see the historical financial operations of the property. We'll also use these statements to compare to your operating pro forma to confirm your operating projections are in line with the operating history of the property and to get a sense of your assumptions regarding property revenues and expenses that may differ from historical operations. And then for operating properties, we're also going to need a physical needs assessment to understand the property condition and the anticipated repairs that may be needed at the site. So this assessment will help to determine if there are, health and safety concerns that need immediate attention, or are there, conditions at the property that need to be addressed in the next 1 to 5 years or 5 to 10 years. What is the expected life of this property, and what are the appropriate reserve levels given the condition of the property? So these are some of the questions that will be addressed with that physical needs assessment. If the physical needs assessment identifies health and safety concerns, the holding period budget, so during that acquisition loan period that Sharon was discussing earlier, the budget should address the shorter term critical repair needs at the property to ensure these issues are addressed right away. Next slide.
So thank you, Josh. So now we'll get to what we consider the third part of our due diligence checklist. So we're going to discuss some of the borrower and sponsor information. And so here is a list of the information that we'll require. But let's start by discussing the schedule of real estate owned. And so this is a document that we will require, assuming you have one, assuming that this is not your first project, assuming that you've done other projects in the past. So really, we'd like for this document to contain the average portfolio occupancy, as well as the debt service coverage for each property. Actually, so we look for the portfolio level and and at the property level for each of these. We'd want to know what the occupancy is at each property, as well as the debt service coverage at each property. We'd want to see what the net cash flow is, again, at the property and at the portfolio level. And we will want to understand if you have any properties where the debt service coverage falls below 1.0 times. We'd want to understand what's causing it and how it will be addressed. And the same for projects where there's an occupancy less than 93%. Really, if and more specifically, if a property is showing both debt service coverage below 1 times and occupancy less than 93%, we definitely want to get an understanding of what's occurring at the property and how you plan to manage that. We'd want to know how projects that are in construction, how they are performing, whether these are on time and on budget, what percentage complete. Are there any projects under construction that you may need to support with your guarantee? And how would you cover any problem projects in the short term? We'd also want to look at your contingent liabilities, and these would typically consist of construction guarantees, operating deficit guarantees, lines of credit, loan guarantees, and mitigants to these guarantees could be that they include burn-offs or reserves to support the properties. Next, we'd also want to look at your developer fee schedule. We'd want to see any projects. We want to know about any projects you anticipate receiving developer fees over the next 2 to 3 years, and when you expect to receive those cash developer fees. And basically, we want to know this information because it helps us understand your cash flow, and it helps us to understand what additional liquidity or cash that you may have available to support your current project if there may any issues should arrive. And then lastly, again, we look for a bio of key staff if this is different from the sponsor. So I'll pause there because I think I see a question come up in the Q&A.
Yeah, this question, can you clarify if an interest reserve is required for properties that meet the required debt service coverage, or is it only required for non-operating projects?
Yes, no, that is a good question. I think Josh alluded to this earlier. So the interest reserve requirement will really be project specific. So if there is an operating project or say operating property and the cash flow from the property can service the debt. And in this case, we'd look for at least 1.1 times or 1.15 times that it can sufficiently service the debt, then most likely we would not require an interest reserve. And again, the property has to show that, or the cash flow has to show that it has consistently been able to service to support the debt on the property. But where there's property or non-operating properties, we will, unless you can show from your own internal cash flow or cash balance that as the sponsor that you can support the debt, we would look to have an interest reserve. So I'll pause there and see if Josh wants to add anything to that.
I think that covers it.
Okay.
And then there's a person asked a second question, curious if the loan amount based on the loan to value per the as-is value in the appraisal, or is that with the affordability restrictions? I know I recall the appraisal usually is inclusive of what the affordability restrictions are, but if that's different, Sharon, please respond.
And Josh, I'll let you respond.
Yeah, I'll take this one. So this is a good question. So if there are going to be, if we're acquiring land or, and there are the local jurisdiction, if there's financing coming from, the city, and they're going to be putting affordability restrictions on the property, then the appraisal is going to need to consider the value of the property with those restrictions on the property. And so we're going to get kind of an as-is value and an as restricted value. And if those restrictions are in place and are not, we are not able to get those restrictions off the property, then we would be looking at the as restricted value to base our loan amount.
Okay. Seeing no additional questions, next slide, please. For the borrower, again, continue with the borrower and sponsor information. So for, again, we will of course look for financial statements. And again, if it's an operating a nonprofit or so, these would be audited, accountant prepared statements. But when it comes to for-profit entities, personal guarantees are required for for-profit entities. And here we'll ask for a personal financial statement. We'd be looking for a certified balance sheet as well as your tax returns, last 3 years of tax returns. We will run a credit report on any individual guarantor. And certain occasions, we will actually ask for backup information to support the liquidity that's stated on your personal financial statements. And so when looking at the personal financial statement, while we're not expecting that you will be able to finance the project with your own personal capital, but what we do need to see is that you have the capacity to support the project if something were to go wrong. So for instance, that you could cover interest expense or other carrying costs while some of the closing or funding sources delayed, or if the project stalls and for some reason it can't move forward, or that it can't move forward for some reason, that you have the capacity to carry the project while you put together your plan B. And, and depending on, your funding source and the complexity of the project, probably, as part of the underwriting, also if the, proposed project does fall through, we want to discuss what is a potential plan, plan B for this project. Now, unless there are any questions, I'll pass it over to Josh to discuss best practices.
Okay, next slide. All right, so some best practices and with some of the information that we've provided here today. So one, provide your lender with a full picture of the loan need, the proposed project, and the repayment strategies and your guarantee capacity. The more complete the picture, the more likely your lender will be to pursue the project with you. And just kind of noting, when we're looking at your guarantee capacity, we're assessing not only your ability to guarantee our loan, but your financial capacity to guarantee the construction financing, which is often the repayment source for our loans. If the construction of the project will involve a joint venture, who do you intend to work with? Again, providing the fullest picture possible at that time, and how we're getting repaid, how we mitigate risk is really important to your lender. Remember that what you're submitting to us for underwriting for pre-development or acquisition, like your financial information, that REO schedule, the list of contingent liabilities and development pipeline. This is also information that your LIHTC investor and your construction lender will need for their underwriting and approval, and you want to provide everyone with a consistent and complete proposal. Really think through your timeline for the project. Can you produce the checklist items in time to get to the closing deadline? What are your longest lead time items? And what is your order of tasks to get to closing on time with us? And can you meet the obligations of our loan repayment based on the timing anticipated receipt of the takeout financing? You're going to want to have as detailed a timeline as possible to track your progress toward our loan closing and through loan repayment, and then through construction of the project. And then lastly, we didn't talk about this much today, but you will need legal counsel to close your loan with us and many other CDFI lenders. In our world of multifamily affordable rental housing, it's important to have legal counsel that's well-versed in affordable housing and real estate to ensure that the closing process proceeds smoothly. So a best practice is to line up good legal counsel for your closing with us and for your future legal needs related to the project. Anything to add, Sharon? If not, I think we can open it up to any final questions.
Yes, I would just say along the same lines in terms of your legal counsel. Also, again, maybe moving into affordable housing, or maybe moving into affordable housing where it's financed by LIHTC. There may be various parts of the transaction that are newer to you as a developer. And that's where it becomes really critical to make sure you're lining up a strong development team. That might be a LIHTC consultant, that might be a development consultant, a new market tax credit consultant, appropriate accounting. But so yeah, depending on, it's critical that you understand, what but then understand where within this process that you might be best served by either bringing in a partner or another consultant to help you move the project and the process through as quickly and as smoothly as possible. So yeah, I think that's it for me.
Yeah, I'm looking here to see if there's any other questions that are coming in. I don't see any. folks want to get anything else in, I'll give them some time to do that. In the meantime, just let folks kind of know, just a brief kind of commercial, that over the next 4 or 5 months, we'll be doing some additional virtual webcasts on a variety of topics. In July, we'll cover affordable housing debt executions, where we'll have expertise from our permanent debt product lines to discuss FHA, Fannie, Freddie, and other types of direct purchase debt structures. Complicated information that we're hoping will provide in a really concise way, with another Q&A on how those products work. In August, we'll do an introduction to the low-income housing tax credits and tax-exempt bonds. We did a lot of touch points on tax credits as a takeout for some of the CDFI lending that we do. We'll go in depth with that particular product to talk about how that can be used for subsidizing the acquisition and construction, as well as rehab of affordable rental housing. In September, we have we'll do a Zoom webcast on developing affordable housing and community facilities in partnership with faith communities. Enterprise has a fairly robust program on how to provide education, training, and capital for faith lenders in our Mid-Atlantic market. We're going to really go deep diving with one of our partners on how community facilities and houses can be developed with this type of partnership. And then in October, we will actually have a really in-depth learning training on understanding the basics of joint venture equity. And this particularly complex structure is used to help a lot of developers and investors who don't have a basic understanding of some of the considerations that go into partnerships. We'll do a real deep dive on how this particular structure a transaction using a JV can be supported and be helpful, and that will be done in October. So hoping that each of those series that I just mentioned do have individual registrations. So the same place that you used to register for the CDFI, you can go to register for those other training sessions, and we'll provide more information on that through this PDF when it's available. So hoping folks will chime in for those as well. I don't see any additional questions coming through. I really want to provide a big thank you to Sharon and to Josh for kicking off this first of our webinar series designed to really support learning for our BIPOC communities, and hoping to see you guys again soon. So thank you again, and thank you, Sharon and Josh, for support on this first of our training. Thank you also to my colleague, Jemima Ochere, for providing the support in the background for getting these slides up and going, and appreciate being able to provide this to our partners. You guys have about 21 minutes left of your day, and we're always about giving folks back their time. So if I do not see any additional questions, I'm going to take one more look in the chat. We will close it out. You guys have a really great rest of your June, and happy holidays going into the 4th of July as well. Take care.
Thank you, Monica. Bye.
Thank you.
Thanks, guys.